Authorization. Authorization is the first formal check that happens when a payment request enters a payment system. At this point, the payer's bank or payment service verifies that the account exists, that it is allowed to send payments, and that there are enough available funds or credit to cover the requested amount. This idea developed as electronic payments replaced paper-based methods, where checks and balances were handled more slowly and often manually. Today, authorization happens in real time across card networks, bank transfer systems, and other electronic payment rails. Its main strength is speed and basic risk control, because invalid or rule-breaking transactions are stopped early. At the same time, authorization does not move any money by itself, and it cannot guarantee that later stages will complete without issues. Clearing is the stage where payment information is organized and compared between the institutions involved. Instead of moving funds immediately, the system focuses on determining who owes what to whom based on completed transactions. Clearing emerged with the growth of interbank payments when it became inefficient to settle every transaction individually. In modern systems, clearinghouses or networks collect transaction data, validate it against shared rules, and calculate obligations between banks over a defined period. This process allows large volumes of payments to be handled in a structured way. The strength of clearing is efficiency and consistency across participants, but it introduces a delay between payment initiation and final settlement, which means obligations exist without funds having moved yet. Settlement. Settlement is the moment when money actually moves between financial institutions to fulfill the obligations created during clearing. This usually happens through accounts held at a central bank or through designated settlement systems that are trusted by participants. The concept dates back to early banking, when balances between banks were periodically adjusted to reflect customer activity. In modern payment systems, settlement may occur several times a day or at the end of a processing cycle. Its key role is to eliminate outstanding obligations by transferring real funds. Settlement provides closure to the payment process, but it depends on liquidity being available at the right time, which can limit how frequently it occurs. Netting is a method used to simplify settlement by combining multiple payment obligations into a single net amount between institutions. Instead of Bank A sending many individual payments to Bank B, the system calculates the difference between what each owes and settles only that final figure. Netting became important as transaction volumes increased and settlement resources remained limited. It is widely used in clearinghouses and large-value payment systems to reduce operational and liquidity demands. The main advantage is that it lowers the total amount of money that needs to move. However, netting also means that individual transactions are not settled one by one, which can increase exposure if a participant fails before settlement. Intermediaries. Intermediaries are organizations or systems that sit between financial institutions to manage payment processing. These include clearinghouses, payment networks, and system operators that define technical standards and procedural rules. Their role developed as payment systems became more complex and interconnected, making direct coordination between every bank impractical. Intermediaries collect transaction data, apply common formats, enforce participation rules, and route information to the right parties. This central coordination improves reliability and interoperability across the system. At the same time, reliance on intermediaries concentrates operational responsibility in a few entities, which means system resilience depends heavily on their stability and governance. Finality. Finality refers to the point at which a payment is considered complete and legally irreversible. This concept exists to provide certainty, so participants know when an obligation has been fully discharged. Finality rules were formalized as payment systems expanded, especially where delays existed between clearing and settlement. In practice, finality is defined by system rules and legal frameworks, often linked to settlement completion in central bank money. Its strength lies in reducing disputes and systemic uncertainty, because once finality is reached, the payment cannot be undone. The trade-off is that achieving finality may require waiting for specific conditions, such as settlement cycles, rather than occurring instantly. If you find this kind of slow, system-level explanation useful, you can subscribe to the channel for more clear, neutral breakdowns of how financial infrastructure works, without opinions or predictions.